Hey everyone, welcome back. Today we're diving into the world of dividend ETF, and specifically why SCHD, one of the most popular options out there, isn't broken, but it is being outperformed. Over the past 3 years, SCHD hasn't just lagged behind the S&P 500, it's also trailed other dividend ETFs that fly under the radar for most investors. In this video, I'll break down 3 dividend ETFs that have quietly beaten SCHD, not just by a little, but by a massive margin. We'll talk about why these funds are outperforming, what companies they actually own, and whether they might make sense as alternatives to SCHD as we head into 2026. Stick around until the end because I'll also explain one scenario where SCHD could still stage a comeback and outperform all of these ETFs. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the basics. When analyzing dividend ETFs, total return is the most important metric because it accounts for both price appreciation and reinvested dividends. And even though SCHD offers a solid yield, its recent performance has been underwhelming. Over the past 3 years, SCHD has returned just 17.7%, translating to a 5.6% compound annual growth rate. In the last year alone, it's down 2.9%. Meanwhile, the ETFs we'll discuss today are in the same dividend-focused category, but have delivered far better results. For example, take Vanguard Dividend Appreciation ETF, VIG. Over 3 years, it has returned 47.9%, which is a 13.9% CAGR, and its one-year return is 9%. VIG has been around since 2006, boasts a tiny 0.05% expense ratio, and holds over 300 companies, managing $116 billion in assets, already surpassing SCHD. The trade-off? VIG has a lower dividend yield at 1.65%, paid quarterly with consistent long-term growth. Its 5-year dividend CAGR is 9.18%, and 3-year CAGR is 6.54%. While you won't see perfectly predictable payouts like individual dividend stocks, VIG's focus is on long-term dividend growth trends. Performance comes down to the companies these ETFs actually hold. VIG, for instance, has strong exposure to tech and dividend growth companies. Key holdings include Broadcom 7%, Microsoft 4.79%, Apple 4.2%, JP Morgan 4%, Eli Lilly 3.1%, Visa 2.5%, MasterCard 2.1%. Technology alone makes up 28.3% of the fund, a huge reason for its outperformance. SCHD, on the other hand, is underweight in tech, an area that has driven much of the market's gains in recent years. Growth stocks matter because companies with rising earnings per share often see their stock prices follow suit. A business that doubles its earnings every 5 years usually delivers both capital appreciation and growing dividends. Microsoft, for example, has a 5-year dividend CAGR of 10.2%, supported by strong free cash flow and net income payout ratios. Financial services also play a role. Companies like Visa and MasterCard are high-margin, network effect businesses that generate predictable cash flow and growing dividends. Visa's 5-year dividend CAGR is 15.9%, with sustainable payout ratios. Next, let's look at Fidelity High Dividend ETF, FDVV. It has a trailing 12-month dividend yield of 3.11%, the highest yield ETF we'll cover today. FDVV has delivered a 3-year total return of 60.7%, or a 17.1% CAGR. Its 1-year return is 9.8%. FDVV launched in 2016, currently manages $7.4 billion in assets, and holds over 100 companies. Its 5-year dividend CAGR is 9.36%. While recent dividend growth has slowed, the key is the underlying businesses. Top holdings include NVIDIA, 6.42%, Microsoft, 5.61%, Apple, 5%, JP Morgan, 2.5%, Broadcom, 2.5%, plus high-yield names like Philip Morris, Coca-Cola, Exxon. FDVV balances growth tech exposure, 26.5%, financial services, 19.4%, and high-yield companies across consumer defensive, real estate, utilities, and energy. This allows for both growth and income. Finally, there's iShares Core Dividend Growth ETF, DGRO. It has 3-year total return, 43.5%, 3-year CAGR, 12.8%, 1-year return, 9.1%, dividend yield, 2.3%, Expense ratio 0.08%. Nearly 400 holdings, $34.69 billion. DGRO doesn't rely heavily on tech, but still outperforms SCHD. Its sector mix: financial services 20.3%, tech 18.9%, healthcare 17.2%. Top holdings include Johnson, Apple, ExxonMobil, JP Morgan, and AbbVie. DGRO's diversified dividend growth strategy highlights that you don't need tech concentration to beat SCHD. To put the difference in perspective, $1,000 in SCHD at 6%, CAGR $3,000 in 20 years, $1,000 in a higher performing ETF at 12%, CAGR $8,600 in 20 years. That's a $5,600 gap, showing the power of compounding over time. SCHD could still outperform under certain scenarios. Its tech exposure is low, dots at 10%, and financial services are under 10%. It's heavier in energy, consumer defensive, healthcare, and industrials, making up less than 40% of the fund. If you believe tech is overvalued or in an AI bubble, SCHD's lower tech exposure could make it a defensive play. Plus, it has the highest dividend yield of the ETFs we discussed, at 3.82%, and a reliable long-term growth track record, 5-year dividend CAGR 7.55%. For investors already holding SCHD, diversifying with one or two of these higher-performing ETFs could balance growth and income. Some ETFs shine when tech does well. SCHD performs better when defensive sectors lead. Total return remains the key metric for long-term investors. Even with higher yields, you can benefit from growth if your portfolio includes quality companies. And if you want broader market exposure, consider an S&P 500 index fund like VU, which returns 74.4% over 3 years, 20.4% CAGR. SCHD isn't broken, but its underweight tech and financial exposure have caused underperformance. VIG, FDVV, and DGRO have beaten SCHD by owning high-growth, high-quality companies. Long-term dividend growth matters more than short-term yield differences. Diversification between SCHD and these ETFs can create a balanced strategy. Scenario planning is key. If tech slows, SCHD could shine. Also, a fun fact for long-term investors: if you had invested $13,640 across a diversified mix of these ETFs 20 years ago, the total compounded value could be well over double or triple the original investment, showing just how powerful strategic dividend investing can be. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.